Everybody, and happy Friday. At least for us, I'm a little late because we do property management and we do inspections periodically. And so we went to inspect a property this morning, not me, but my team. And a person had passed away in his 50s. So anyway, I'm a little bit befuddled. Sorry, because this doesn't happen that often. Anyway, what's going on in real estate? We listed 244 homes yesterday, which is marvelous. That gives us 4,735 homes. And let's see, we closed 389 homes. Oh my goodness gracious. Is that a typo? No. I think it's a typo. Yeah, that's a typo. I'll have to fix it. Yes, I'll fix it before I post it. I thought, no, we didn't. Yeah, that's a typo. Sorry about that. Like I said, just a little befuddled today. 31% of the homes on the market are median price and under $485,000, and 31% of the market is that number of homes. We're selling 111 so far this month, which is only. Today's the 3rd, so that's for 2 days. We were selling 111. I suspect that will go up. And not too much is going on. Everything's kind of the same. 35 to 38 days, 35 to 37 days of inventory. I will fix that closing so it'll reflect the right number. But that's it. And this is, please go away, Zillow. There we go. So for the first 2 days, our median price inched up, and it's kind of interesting to see, how this goes. But I would suspect that's going to go down. So I wanted just to show you what it is like the first 2 days of the month, and then we'll do it like every week and see how things are going to get affected here because of the interest rates and other things that are going on in our market. You see the average has gone up as well. So the average for May went down, which is, I don't know. I'm not a statistician, so I'm not real sure why that happened, but we shall see. But I think you're going to see a little break here coming soon. Let's see. The other thing we want to talk about today is the $1 million home. And it's an interesting scenario today. Let me put myself back down here. It's a $21 million home, $21,500,000, 7 bedrooms, 11 bathrooms, 14,331 square feet. Oh my goodness. And Zillow says it's worth $5,996,000. So I thought that was kind of funny. They got that all wrong, but they knew it. Here's the funny thing. They knew it was wrong, right? They must have some filter in there that says, whoa, there's something wrong with this picture. So it says the list price and Zestimate for this home are very different. So we might be measuring something wrong. And that's interesting that they say that. Beautiful home listed by Ivan Shear in Berkshire Hathaway. It has been on the market, I believe that this home has been on the market 20 hours and already has 635 views and 51 people saved it. So there you go. We'll see. It's not the most expensive home we have on the market in Las Vegas. That would be the $32,500,000 home. So this is probably number 2. I think that's what I saw. Again, forgive me. Yeah, so let's look at this here. I thought this was just interesting. Yes. Yeah. So we might be missing something. I think so. I think they're missing something. But I thought that was interesting that they do that. And I think, I'm not a Zillow fan, but I think that's nice that they do that. And the interesting thing was, here's the tidbit there. So I went into the tax records because sometimes Realist and the Tax Star will show you what they think the value is. And they basically estimated it right around 7,500,000. So I don't know if Zillow, if they're getting it from the tax records, but anyway, their program says, oh, this is too different, so something's wrong. We'll see how that plays out. I don't know if they're going to change it or what happens. Anyway, this is a beautiful home. It is a beautiful home. It has a 9-car garage, everybody. Can you believe it? A 9-car garage. I can't even think of that. That's huge. And this is, Ivan Shear has a nice website, and it's all about homes. There's nothing else really too much except homes, on his website. So let's see this. Yeah. Yes, it's so the comments read, envelop yourself in new heights of luxury at a stunningly modern, double-gated reserve McDonald Highlands masterpiece. This is an architectural tour de force along with world-class amenities at Dragon Ridge Country Club. This home sits on 1.1 acres, and it features 14,331 square feet, 7 bedrooms, all en suite, and 11 bathrooms, including a private 2-bedroom, 2-bath, 2-story casita, which is 1,545 square feet, and it has a living room and a kitchen. So the front courtyard with large reflection pools leading to the large pivot front door has a dining room with seating for 16. It has a separate wine room. It has a kitchen island seating for 16. It has a elevator in the home, and it, as said earlier, a 12-car garage, and it has a separate workshop. So the primary bedroom suite features a covered deck with an outdoor spa. How lovely. A large primary bath with a private outdoor space with a shower and water feature, and expansive his and her closets. I could just imagine. Complete with a stunning outdoor space with a pool with a the Horizon pool, and it has an outdoor kitchen and a separate pool shower. So when you're out at the pool, you can take your shower, and it also has a bathroom. And this exclusive estate is scheduled for completion at the end of 2023. So this home is not totally finished yet. And it was interesting, they're offering 3%, everybody. So if you need $630,000, you might want to work on selling this home. Surely it's going to go to a special buyer. This is one of the prettiest contemporary homes. And when I think of contemporary, I always think of no real walls, all open living, and oops, my puppies. Anyway, yeah, and look at the view. Oh my gosh, there is a view of the city that is to die for. And we're going to see it in just a second. I think toward the end of the video, they show, look at that outdoor seating. Oh my goodness, it's gorgeous, everybody. Of course, the earnest money is $1 million for this $21 million home. And let's see if there's anything else that was, well, the 12-car garage, just by the way, is 12,783 square feet. So this sits on, like I said, 1.1 acres. And look at those views. Look at the moon that night. Oh, they really did it well. They really did it well. Here we go. Here's the view. Here's the tour de force. Oh my goodness. Yep, that's it. So that's the $1 million home. Unbelievable. Just unbelievable for me. Like I said, I was in a little bit of a hurry today, but let's see if I can find, no, that's not it. I think that there's, let's see. No, that's not it. Where did it go? Hang on, everybody. Hang on. Let's see. I thought about, here it is. Is this it? Okay. So I want to play a little bit of this, and I'm not going to play it all, but we're going to play a little bit. And I don't know if you listen to NREP Daily. Some of their things are really good.
Hey guys, Brian Stevens here with the National Real Estate Post. I have Dave Stevens, a regular participant in what we talk about to really kind of untie some of the more complicated issues that the mortgage market is really talking about and dealing with on a regular basis. Today we're talking because Mark Calabria, the past head of the FHFA, came out and said that we're on a ticking time bomb, that the mortgage market is basically going to have massive problems in front of us, and that's based on the book of business that FHA wrote. Now, the last time I checked, Dave, and I could be wrong on this, but I think the average credit score of an FHA borrower right now is somewhere to the tune of 680 to 720. I mean, it's a pretty decent book of business. And he mentioned how nobody has skin in the game with, a 3% down payment, yet everybody is dealing with massive equity on a level that we've never seen in the history of this country. So when I hear him say that, my knee-jerk reaction is he's out of tune with what's going on. But there's another part of me that says, what am I missing right now? Like, where is the housing market going to fall apart?
Yeah, I mean, I responded in a public interview, as did Mark Zandi and another guy named Jim Parrott, who's very well known in inside the Beltway and used to work on the National Economic Council for the president. But and we all kind of said the same thing out of coincidence about the market. Look, we have the healthiest screwed up market you could ever be in, right? And this goes all the way back to COVID. When we went into COVID, we had really amazing credit conditions. We came out of COVID with an economy literally on fire, so strong that the Fed is now using all its abilities to stop this thing before it has an even worse outcome. And by the way, they're doing a really good job doing that. But people are misreading a lot of information. I mean, if you want to look at just one simple picture here, this is from a presentation given by Moody's Analytics, which is the big ratings agency in New York, to a whole bunch of analysts this week, and it just shows where we are in housing. So I just want you to compare this slide to the Great Recession. The Great Recession of 2008 was a very different scenario. First of all, FICO scores, which is the green bar, were significantly lower, and homeownership equity was also significantly lower. Today we have, and this is identified in this bar, this chart identifies the green areas, the percent of mortgage debt to borrowers with credit scores that are less than 700, okay? So it's a percent of borrowers who have credit scores less than 700. If you go down to 2008 during the Great Recession, 65% of all borrowers had a sub 700 FICO. Today it's down, somewhere around 22%. So pretty incredible scenario. And when you look at homeownership equity, in terms of overall equity in the country compared to that period of time, it's enormous. By the way, we have more home equity than has ever existed in America today. Now, look, a lot of people, and you and I talked a little bit beforehand, a lot of people want to, I don't care what the data says, I still feel this way.
Right.
It's sort of that's the nature of our world today. It's all the world of fake news, and I don't trust science and math. But the thing I will tell you is, will we have higher delinquencies? Likely, but I'll even give you fresh off the presses from FHA, because they just released their monthly report, which FHA publishes on their website every single month. And it's a performance report on FHA, but the total delinquency increased 11 basis points. Delinquency doesn't mean foreclosure. Delinquency is 30-day delinquencies are the predominant part of the delinquency number. They increased from 9.69 to 9.8, which is a few basis points, still lower than February of 2020. Now, why February of 2020 is important is that's pre-COVID, right? We shut down in March. So we were, everything was still going in February 2020. I would argue February 2020 was a pretty damn healthy economy before COVID, with rates dropping for other reasons, and that delinquency rate in February was 10.61. So there's a variety of things happening here. One is the reason why I take issue with Calabria, and why I think while there's weakness in the housing market, and there will be, and we're likely to see home price appreciation go down to probably near flat, maybe a couple basis points of appreciation for a while, has to do with shortness of supply, increases in interest rates, consumer sentiment, which is down, and all of that is frankly scaring the hell out of potential home buyers. They're backing away a bit. We have increased inventory. I can show you another slide on that in a minute if you want to see it, that the Fed just released. But supply now, we have about a 9-month supply of housing stock. We're just literally, and that's the full April report. For the March report, we had about 6 months supply, and literally 6 months ago we had 2 months supply. So the supply of housing is increasing. By the way, that data point, if anyone wants to check it, is go to the Federal Reserve of St. Louis, FRED, F-R-E-D, and you can track the month's supply of housing in America, and that's the listing volume. That's just listed currently on MLS sites across the country. Just real quick, all I want to say is the dynamics that are shaping what will produce a net outcome from the Fed's actions post-pandemic, probably some form of recession and beyond, are still not enough to do anything, any way, shape, or form that the Great Recession did. And that has to do with credit quality, current equity positions of American homeowners today, savings statistics of what Americans hold in savings banks, all the ex-post Dodd-Frank stuff, that all this stuff is QM, when before they were negams and subprime 228s, 327, pay option arms, whatever. It's just, you have to look at the data that's the underpinning of the market that we're in today.
So when I read what Calabria wrote, and again, I'm a simpleton, but I look at this stuff on a daily basis. I do, and I'm seeing a world that is entirely different than his. The cleanest book of business we've ever written, more equity than we've ever had. The most meat and potato type of loans that we've ever had. We're just doing Fannie, Freddie, Ginnie with a small sprinkling of non-QM right now. And I guess the question I have is something I read is have we gotten to a point to where our credit availability index with the Mortgage Bankers Association has tightened up so much? I kind of feel like we need to go in the other direction. Should we start looking at not only just interest-only loans, but all the old NAGAM loans? Do those have a place in the market that we're dealing with right now? And are those some of the solutions that should be on the table? Seriously, I kind of think it does.
I do think, look, you're a Californian. I'm a former Californian. I grew up working for a California S&L doing pay option arms. There has to be a better focus on affordability. And you watch, as we're talking today, Sandra Thompson on the 25th of May will be confirmed by the Senate today. She just passed cloture, and we will have a full-time permanent director of the FHFA. Really important, because what Sandra could do had some limitations as acting director, and I think she's going to really focus significantly on affordability and access in some of the moves she makes for the exact reason. And if I can say nothing else, just think about the term cross subsidy. So the best cross subsidy we have in federal lending programs is the FHA. Cross subsidy means that you could be godlike with an 850 FICO and a 50 LTV, and if you decide to get an FHA loan, which you wouldn't, but if you did, right, you would get the same rate, fee, everything as the 620 FICO borrower putting 3% down. That's a true cost subsidy, where the better credits subsidize the weaker credits. The GSEs on a pure credit risk model, the way they operate, there's really no room for entry level or first-time home buyers, particularly anybody with a wrinkle in their lives. As you all know, as loan officers, if you have any of that, the trade away to FHA is somewhere in the low 700s in the FICO band. If you have a really low down payment, because between LLPAs and MIP, it just doesn't work. And so this is something that I promise you, Sandra will focus on as FHFA director. And keep in mind, gang, Julia Gordon just got confirmed a few days ago, last Friday, to head the FHA. She is going to reduce MIPs. I promise you. That's a fact, guaranteed.
Right there.
Yes, I promise you she will do that. I'm not sure she's going to do it across the board. I think she's trying to finesse it in odd ways. But I think in the end of the day, she'll do some various forms of across the board MIP cuts, because she knows they're priced too high, given any scenario of increased defaults that could occur on the FHA program. That premium that they're collecting today is so high. I put most of the premiums in place when I was commissioner, and I had to pass a law to get my ability to raise them even further. Those premiums are able to withstand a near 20% actual default rate, not just delinquency rate. And so, they're just, it's too much, and it's turning them into a profit center. And so I think you'll see some action on both sides there that's going to move the dial a bit. And I think the good news is we now have a actual confirmed commissioner, which is what Secretary Fudge was waiting for. And we have an actual confirmed FHFA director, because her hands were somewhat tied in terms of how far she'd go in PSPA modifications, preferred stock purchase agreement modifications, for the GSEs, how more specifically she could drive GSE affordable housing goals. And they're going to release that plan in the next few days, I believe. And what she could do to a more targeted cross-subsidy effort that will reduce some of the LLPA buckets for first-time home buyers with lower FICOs. And that will probably increase perhaps some of the LLPA buckets down on the better quality side of the grid in order to allow the GSEs to do more affordable lending. I also expect in the plan that they'll release over the next few days to see things around manufactured housing and things of this sort. But that all of this is going to come from two confirmed new heads of two critical agencies that we don't pay much attention to out on the street. You just worry about what rates your secondary marketing officer is going to give you or your investor's giving you. But in the end of the day, they really matter, because what secondary can provide, at least as it relates to the government programs, depends a lot on what these two individuals decide to do.
So you're seeing decisions coming that you think are going to be swift and transformative in terms of what we're doing right now with the GSEs and with HUD.
Yeah, I mean, swift and government talk. But here over the next couple of months, I think you'll see the initial steps. And think about it this way, guys. Mike Fratantoni, the chief economist for Freddie Mac, wrote a really good article at Housing Wire this week, where he said Fannie and Freddie are not price takers in the marketplace. A price taker, by definition, would be if UWM decides to lower rates even subpar, the other wholesalers probably have to get close to that. They have to take that price and compete with it. Otherwise, they don't do loans. A price maker is what the GSEs are. They don't have real competition per se. They match themselves against their counterparty, which is Freddie versus Fannie and vice versa. But they're price makers, and they don't really have to compete, except if FHA lowers the MIP. That's going to even lower even further the trade-away FICO that might, if 720 today below on a 5% down loan means FHA is best X. If they lower premiums by X and it now turns out that a 680 or 690 FICO is best X for FHA, the GSEs are now going to have to be at some level price takers, meaning they're going to have to do something about pricing in order to not lose all that affordable business, because they have housing goals that they're going to have to meet, and they're barely doing well in that space today. They can't lose more ground there. So in that sense, we're going to see some interesting dynamics depending what FHA does first.
Kind of out of left field, I don't even know if this needs to make it into the show, but one of the topics that I've been looking at over the past couple of weeks that is just has me scratching my head is Freddie Mac talking about targeted loans and coming out with a new product, a new process with targeted loans. Do you have any thoughts on that?
Targeted loans meaning affordable loans?
Targeted loans, yes. Very, very specifically, targeting loans towards underserved communities.
Absolutely. I could absolutely see them doing this. There's been a desire in proposed legislative efforts. You did not see them, but on the infrastructure bill, the Build Back Better bill, which never got passed, and I don't think it can in a midterm election year, but even as in a scaled down version, it'll be tough enough. But there was a piece of legislation in there coming out of the House Financial Services Committee, which had an effort to provide down payment assistance to based on percentage of area median income. And that in itself is a way to essentially back in to census tracts. But the other way to do that is actually to specify census tracts. So you could come up with a product model that takes where the model builds out a census tract outcome that says this list of census tracts has an average AMI, average median income below X.
Right.
And so this product will be available for those census tracts. And as such, will have some form of subsidy, both in pricing and credit to get originators providing those. You might see those in a housing plan. I mean, one thing that I'm sure most of you are not aware of because you don't live your life in this gobbledygook and you're worried more about volume and other things in the business that's happening right now. The GSEs submitted affordable housing goals to FHFA many months ago, and Sandra rejected them. And all out rejected them completely for both Freddie and Fannie. I've worked at Freddie and been around the GSEs my career, and I've never seen goals just outright rejected. And that's what happened here. So it tells me that they did not go anywhere near far enough. A targeted program is one that I could certainly see being on the table. I'm certain that originators would worry about it. Because operationally, it's really difficult, as you can imagine, if you're do anything in change management or loan origination systems, to come out with something that would present that loan through Encompass or whatever. Suddenly, they'll have to load up a bunch of census tracts to match up against a particular loan product available by a GSE. And more importantly, how will the MIs price them, and will all the lenders want to offer them, and will they be in all systems? So all of this stuff is going to be an interesting dynamic. I'm not sure how they'll do a targeted program. I'm not saying it's going to be census tract driven. It could be strictly an AMI driven program, which has been another proposal. You just take, available to 80 or even 100% of area median income. Even 110 or 120 would make sense, because in area median income, at 120% of area median income, you're still probably closer to an entry-level home buyer. Got a lot of renters in that kind of income space. So, it's just an interesting thing about how all this policy stuff is going to come down the wire.
Well, I mean, what a interesting world that we live in right now. Again, my whole thing is, when I was talking with my team today, I'm like, what am I missing about what's going on right now? It seems to me that all the typical indicators that we used to look at that would basically dictate the direction the market is going to go, that's been all kind of turned upside down right now. And I think that's a lot of the reason for the speculation that we have in terms of...
Well, can I share with you just two things?
Please.
So this is the most recent revised forecast from the Mortgage Bankers Association, just presented at the Legal Issues Conference, which is down in Florida right now as we speak. So it's presented, I think it's being presented Wednesday, today. And Mike Curtis generously sent me his deck so I could use it in the presentation. Look at 2022, guys. Don't bother with the green or yellow bars just yet. Just look at the gray line. The gray line is total origination volume. And as you can see, the forecast for 2022 is $2.5 trillion, which is pretty consistent. He was at about 6.5, and he just revised it down to 2.5 based on current market activity that's going on.
So, very interesting information here. Let me make sure I'm good. So off. Okay. Very interesting information. And I put the YouTube address in there if you want to watch the rest of it, or you want to watch it again, or pause it, and whenever you want to do, you can maybe share it with people. But interesting things that, when you think about it, the mortgage companies can't go out of business, obviously, right? And they had like all these refis going on, and that was like a wonderful wizard of business for them. And now things are changing drastically. So the FHA, like you heard David say, is that the mortgage interest is going to go down. He predicts that right up here, MI price reduction. That's what he's predicting. And he's predicting that because because the mortgage companies can't go out of business, and FHA really wants to target, you heard that word many times, target people to come back into the market that perhaps have been pushed away because of, the increasing prices and the increasing interest rates. So that's all good. Now my dog's barking. Anyway, so I would definitely listen to that and be able to articulate it to perhaps people that need to hear it. And maybe you can, don't let your first-time home buyers go, because there may be some relief coming in the mortgage industry for them, FHA. And so anyway, that's it for today. I want to let you know we have a contracts class on Monday from 10 to 1. Jimmy's been in Disneyland all week with his family. What a wonderful thing for him. And he'll be back Monday to teach the class from 10 to 1. That's June the 6th. That's this Monday. And it is a fantastic class about disclosures. It's really digs deep, and you will be amazed at what you can provide for your buyers and the additional information, and it'll make you look I'm sure you're all professional, but it'll make you look even more professional when you can tell them what is in some of the disclosures and the websites that they can go to find out information. Anyway, I hope you'll have a wonderful weekend. I'm looking forward to it for sure. Just think positive, and we're going to make it through this market. We're going to make it. We always do. Love you all, and have a great weekend. Subscribe if you haven't. Please give me and hit the notification bell on YouTube so that you can get notified when I do go live. It's been a little sporadic the past several weeks, but that's life in the fast lane, I guess. I love you all, and see you soon.